Today we are going to talk about the future of institutional finance, risk in DeFi, and stablecoins that were recently covered in a detailed report by RFS Consulting and the On-Chain Foundation. So let's dive in by first understanding what DeFi is and why it matters. DeFi, or decentralized finance, is basically finance run by code instead of banks. You have apps for lending, borrowing, and trading that live on a blockchain, with billions of dollars logged into them. No branch office, no call center, just software and smart contracts. At the same time, new laws and proposals like the Genius Act and FIT21 are trying to make this space safer and more transparent. So one of the big questions raised in the report is, how can people and institutions use DeFi and stablecoins in a smart, responsible way rather than just chasing hype? To explore that, the authors introduce a 5-dimensional risk framework. Think of it as a structured checklist. Are we being sensible with DeFi and digital assets? Here are the 5 risk dimensions discussed in the report. First, governance and responsibility. This is simply about who decides what and whether they understand it. Is there a clear policy for using DeFi? Are decisions documented so you know who approved a strategy and on what basis? Second, stablecoin liquidity and counterparty risk. A stablecoin is a crypto token designed to stay around $1. But behind that promise are key questions. Who issues the coin? What backs it? Cash, government bonds, or something more complex? And in a crisis, can you actually redeem it quickly and at full value? Third, regulatory classification risk. Under proposals like FIT21, a token might start out under one regulatory category and later move to another as it becomes more decentralized. If you don't follow that journey, you might be treating an asset one way while the regulator increasingly treats it another way. Fourth, smart contract assurance. A smart contract is just code that automatically executes on the blockchain. No human needs to approve each step. The key questions here are, has this code been audited? Is it monitored over time? Is there any emergency mechanism if something goes wrong, like a bug or a hack? And finally, reputation and strategy. Does your approach to DeFi make you look thoughtful and risk-aware? Or does it look like you're just gambling with something you don't fully understand? The report combines these dimensions into a single risk score. So you can say, here's our overall DeFi risk level, and these are the factors behind it. A large part of the report dives into stablecoins because they are becoming the plumbing of this new digital financial system. It highlights 3 main types: fiat-backed stablecoins like USDC or USDT, backed by traditional assets such as cash and short-term government bonds; crypto-collateralized stablecoins like DAI, backed by other crypto assets, usually with extra collateral as a buffer; and synthetic or hedged stablecoins, which use trading strategies and derivatives to keep their price close to $1. Now here's a key insight the report emphasizes, what you might call the stability paradox. A coin that looks perfectly stable in calm times can still wobble badly in a stress scenario. We've already seen moments where supposedly safe stablecoins briefly dropped below $1 during banking or market shocks. So the real question isn't only, is this stablecoin exactly at $1 today? It's also, how does this design behave when markets are under serious pressure? The Genius Act, as summarized in the report, tries to address this by requiring things like 100% reserve backing, regular third-party attestations, and fast, reliable redemptions. In plain language, if you issue a digital version of the dollar, you should behave like someone holding real dollars for other people with proper transparency and discipline. Another important idea from the report is the Regulatory Intelligence Framework, or RIF. Instead of judging DeFi apps by hype, brand, or follower count, RIF scores them using what they actually do on-chain. It looks at factors like how well the smart contracts have been reviewed and monitored, how healthy the liquidity is, and how reliable the oracles are. An oracle is simply a data feed that brings real-world prices onto the blockchain. It also considers how governance decisions are made and whether there is meaningful legal and compliance structure around the project. Linked to this is the concept of embedded supervision. In the traditional world, we wait for quarterly reports, audits, and long PDFs. With embedded supervision, you read the public blockchain directly and run live dashboards on top of it. For example, these dashboards can monitor if a stablecoin drifts away from $1 for too long, or an oracle stops updating and prices look stale, or a lending pool gets dangerously close to fully utilized, which can make it vulnerable during stress. When something looks risky, the system can flag it quickly so exposure can be adjusted in real time instead of discovering the problem months later. This idea of seeing risk live, not just in hindsight, is a central theme throughout the report. So what's the big takeaway? The report suggests that good risk management in DeFi is not a brake on innovation. It can actually be a competitive advantage. People and organizations that use a clear framework like this 5D model, choose their stablecoins carefully, and pay attention to real-time on-chain signals will be the ones who capture the upside of DeFi without blowing up their reputation or their finances. The question isn't, is DeFi and are stablecoins too risky to ever be part of real finance? They're already being used, tested, and integrated into the financial system every day. The real question is, who will learn to use them with the right risk tools and governance early, and who will be forced to catch up later? If you want the full deep dive behind these ideas, make sure you read the report, The Blueprint, DeFi Risk, Stablecoins, and the Future of Institutional Finance. I'll leave a link in the description. And if this breakdown helped you see DeFi and stablecoins more clearly, hit like, subscribe, and turn on notifications for more explainers on the future of finance and technology. Thanks for watching. See you in the next one.